Hi, everyone, and welcome to today's session titled New U.S. Climate Regulations. Are you ready? So as the name indicates, we will be discussing some emerging U.S. climate regulations as well as a European regulation that will have an impact on some U.S. businesses. Our goal today is really to cover the requirements of the rules, who they might apply to, the timeline of implementation, as well as why you should start preparing as soon as possible and how you can get started with your preparations. I'm Nicole Sullivan. I'm the Director of Climate Services for Carbon Better. I'm an environmental engineer by trade, and I support clients at every step of their sustainability journey. So everything from quantifying environmental impacts, doing carbon accounting, setting goals for carbon reductions, as well as sustainability reporting. And then I actually help clients to actively decarbonize, both through participation in the voluntary carbon market, as well as through direct reductions. So before I hand it over to Dominic to introduce himself, I'd like to call to your attention a couple of features of the webinar. In the bottom right-hand side of your screen, you should see a questions button as well as a chat button. Chris from our team is graciously moderating the chat today, so feel free to engage as we go. But questions will be answered at the end of the session, and we would prefer you to enter questions in the question box. The session is also being recorded. So after the session, you will be able to replay that and share that. With that, Dominic, can you introduce yourself?
Yeah. Hi, everybody. My name is Dominic Sung. I'm Director of Business Development for Carbon Better. And after almost 20 years in the energy trading and structured finance, I'm focused on trying to help clients on their sustainability journey measure, report, and reduce their emissions in a transparent, traceable, and pragmatic way.
Thank you. So before we dive into a select few proposed and active regulations today, I want to start by looking at the global regulatory framework for climate regulations. So this chart here was put together by Boston Consulting Group in partnership with the World Economic Forum. And since the Paris Agreement was adopted in December of 2015, we have seen a sharp increase of climate regulations globally. So just last year, from the period between January to October, we saw more than 1,100 new climate regulations. So in reality, even if the regulations we discussed today that are currently in a proposed state don't hit, it's likely not a matter of if there will be climate regulations, but when, as we are seeing an upward trend in the number of regulations globally. So to give some context of some of the concepts that the rules we're talking about today will require, I first want to give just like a really quick primer on carbon emissions. You'll sometimes hear that referred to as carbon accounting, greenhouse gas emissions quantification, as well as carbon footprinting. But greenhouse gas emissions are typically broken into three different scopes. So you have your scope 1 emissions, which are your direct emissions from operating and fuel combustion. So this would include things like natural gas furnaces, fleet vehicles. Then you have scope 2 emissions, which are your indirect emissions from purchased energy. So if you consume electricity at your facility, there are still emissions associated with the grid and a power plant generating that power that you consume. Those fall under scope 2. And then scope 3 is everything else. And this can be the most complicated emission source to quantify because your scope 3 includes your supply chain, as well as all other emission sources from operations, such as corporate travel even. And then on the other side of this chart here, you see reductions. So carbon reductions are sometimes referred to as decarbonization. And these include things like direct reductions. These would be like operational changes or equipment swap outs, as well as indirect reductions such as carbon credits, where one carbon credit or offset equals 1 metric ton of carbon dioxide equivalent reduced. And then we also have renewable energy certificates, which can be used to offset your electricity consumption. So if your emissions minus your reductions equals 0, that's what we commonly refer to as net zero. But I just wanted to tee up those concepts, as well as introduce a few of the disclosures and reporting frameworks out there, as well as a target setting framework that we'll be talking about today. So some common disclosure frameworks that you see are the CDP, which was formerly referred to as the Climate Disclosure Project, as well as the Task Force on Climate-Related Financial Disclosures, the Sustainability Accounting Standards Board, or SASB, and then a common protocol utilized to quantify greenhouse gas emissions is the Greenhouse Gas Protocol. Now, this list isn't comprehensive of all the frameworks and protocols out there today, but these are some of the ones relevant to the rules we'll be discussing. And then you can set targets to reduce your emissions, reduce your water usage, anything environmental related and KPI related, you can set targets for. But there is a process through which you can set science-based targets through the Science-Based Targets Initiative, or SBTI. And to set science-based targets that are aligned with rapidly reducing greenhouse gas emissions to limit warming to 1.5 degrees Celsius under the SBTI protocols, you actually have to submit your targets to the SBTI for approval. So some of the rules we'll talk about today actually do reference SBTI. All right, so I've thrown a lot at you, but there's also way more you could take a deep dive on as it relates to disclosures and different frameworks. So we actually wrote a white paper on this topic late last year, and you can download it with this QR code here. This is an overview of all things sustainability reporting, and does have a helpful summary of some of the broader frameworks out there beyond the ones we'll be covering today. All right, so now with that context, I'd like to highlight the 3 rules that this session will be focused on. So we're going to take a look at the proposed SEC climate disclosure rule, which would in fact affect public companies in the US. We'll look at the proposed federal supplier climate disclosure rule impacting federal suppliers in the US. Note, both of these are in a proposed state. They are not officially rules that you have to comply with yet. But they are proposed and they could become effective either as written or as in a revised state. So I just wanted to keep that in mind that these are proposed currently. And then there's also a European Union reg called the Corporate Sustainability Reporting Directive, or the CSRD. And that rule is officially a rule already, and it will have impacts on some US companies. So these are the 3 we're taking a deep dive on today. There are, as you saw in the previous slide, with the chart of all the regs out there globally that are emerging, like, these are 3 we're focusing on. You might have other climate-related disclosure rules applicable to you. And while we are seeking to give an overview of the rules today, please note this is not professional advice for compliance on these rules, nor is it legal advice. This is just our way of sharing with you what we feel is really important information and timely information. So with that, I'm going to hand it over to Dominic to unpack the proposed SEC climate disclosure rule.
Yeah, so let's dive right in. So who does this affect? This affects public companies registered with the SEC in the US. And SEC Commissioner Crenshaw has said that between 2019 and 2020, 33% of all annual reports filed by public companies contain disclosure related to climate, and 2/3 of the S&P 500 have established a target for carbon emissions. The disclosure of material environmental issues that have material financial impact for a company has been addressed in some form or fashion by the SEC for decades. And it's the SEC's stance that there is an obligation to provide disclosure related to the effects of climate change. There's so much money that's invested in public companies, tens of trillions of dollars, and so many companies are voluntarily reporting climate-related information outside of their public filings. The regulation had to come as there's a recognition that climate risks can pose significant financial risks to companies. Investors want consistent, comparable, and reliable information, and in the SEC's view, they weren't getting it. So what's required as the proposed rule is written? All the proposed disclosures are in accordance with the broadly accepted disclosure frameworks that Nicole referenced before, like the Task Force on Climate-Related Financial Disclosures and the Greenhouse Gas Protocol. But what's required is written now are 1, to disclose your greenhouse gas emissions, so your scope 1 and 2 emissions in different forms, your scope 3 if it's material, or if you have a scope 3 target that's been set. And then the TCFD related provisions are that they require companies to disclose oversight and governance in place to manage their climate related risks by management and company's board, including having a climate expert on that board, and how the company identifies and manages how the company identifies and their strategy for addressing the climate-related risks and the metrics to measure that progress. There's also a disclosure that's necessary in a note to financial statements of how identified climate-related risks have or may affect individual line items if the aggregate climate impact is over 1% of the line item. So this is scenario analysis akin to financial disclosures that are already in play for MD&A sections of filings disclosing material events and uncertainties known to management that can affect future financial conditions. So what's the timeline of this rule? It's anticipated that as early as April 2023, this could take effect. Should the rule become final, there will be a transition period provided to meet these new requirements. And from what we're hearing in response to the comment period, which has been voluminous at almost 15,000 comments, the most controversial items seem to be Scope 3 emissions, climate-related risk disclosures, inclusive of the 1% materiality threshold, and around assurances, like having a climate expert on your board. It's anticipated that there will be some legal challenges to the rule that may alter the timing of the final rule, so we'll have to see how that plays out. But again, it's anticipated that this may be final as early as April 2023. And at the end of the day, climate risk is financial risk. So I'll throw it back over to Nicole to talk a little bit more about the Federal Supplier Climate Disclosure Rule.
All right, thanks, Dominic. So the US government is actually the world's single largest buyer of goods and services. And in the last fiscal year, they purchased 630 billion. So the US government has now decided to actually implement climate regulations to work towards their own climate goals and, drive change with their purchase power. So organizations affected by this proposed supplier disclosure rule include any federal contractors that do more than $7.5 million in federal contract revenue. So for the purposes of the rule and the corresponding requirements, the proposed rule as written actually divides federal suppliers into two buckets. There's significant federal contractors, which do an annual federal revenue between $7.5 million and $50 million, whereas major contractors are doing federal contract revenue greater than $50 million. There are exemptions for contractors with less than $7.5 million in revenue, and other criteria as well, such as it excludes universities and some nonprofits. So there are exemptions, but as a general rule, as written in this proposed state, anyone that's doing more than 7.5 million in contract revenue would be impacted. And something that's important to note too is even if you're not doing $7.5 million in revenue yet, but you're working to grow your contract revenue, if you then cross over that threshold, you would become subject to this proposed rule if it's passed as written. So let's dig into what's actually required in this one. As I noted, there's two different buckets of applicable suppliers that have requirements, and those requirements are fairly different. So your major contractors, which have more than 50 million in revenue, have the most significant compliance obligations in the current state. So major contractors would be required to quantify their Scope 1, Scope 2, and Scope 3 emissions and disclose those emissions through CDP. They'd also be obligated to disclose their climate-related financial risks through CDP. And then lastly, they're required not just to set decarbonization targets, but to actually set science-based targets through SBTI and have those targets accepted. Significant contractors, on the other hand, simply must quantify their Scope 1 and 2 emissions and disclose those emissions. But there's no guidance given in the rule as to how they must disclose those emissions. So they don't have to disclose through CDP, even though they could choose to do so optionally. And then other contractors with less than 7.5 million in revenue are exempt. So from a timing perspective, the rule takes a phased approach towards compliance. So within 1 year of the date of publication, both major and significant contractors would have to start quantifying and disclosing their total annual scope 1 and 2 emissions. And then the more complex requirements for major contractors would take effect in 2 years of publication. So major contractors with greater than 50 million in revenue would subsequently have to disclose their scope 3 emissions as well as their climate risks, and their SBTI targets would need to be accepted as well within 2 years of the date of publication. So it is a lot of things to get done within 2 years of the publication date, as you're not relying just on internal resources. Like, you do actually have to submit your targets, get your targets approved. So for those major contractors, I do want to highlight that, like, it's going to take you a while if you're not already doing these things. So those 2 years could go by quickly. So the public comment period for this rule was originally supposed to end in January of this year. And note, the rule, or the proposed rule rather, was published in November of 2022. The comment period actually ended up getting extended to February of this year. And in reviewing those comments, we've seen pushback from folks around the requirement for SBTI as the only mechanism for setting and having your targets accepted. So with the SBTI being a third party entity, outside of the federal government, some of the pushback was that that gives this organization a lot of power over how federal suppliers set their goals. And then, similar to the SEC proposed rule, there was pushback as well on the level of effort around quantifying scope 3 emissions. And then also, some contractors commented on just the vast difference in level of effort between significant and major contractors. So it'll be interesting to watch how this evolves, but I just wanted to call out some of those differences, as well as some of the feedback that the rule has gotten. So with that, I'm going to hand it back to Dominic to talk about the EU's Corporate Sustainability Reporting Directive and how that's going to affect US companies.
Yeah, and just as a reminder, the CSRD is the one of the three rules that is approved, although the protocols are being finalized, but the rule is approved. So the CSRD will replace the non-financial reporting directive and is the European Commission's first common reporting framework focused on non-financial ESG data. Similar to the SEC, the European Commission stated that the need to update the NFRD because reported information can be hard to compare from company to company, and users of the information are often unsure whether they can trust it. So who does this affect? The guidelines in this rule are actually really clear and straightforward. So in one case, it will affect US-based subsidiaries of EU companies exceeding 2 of the 3 criteria of 250 employees over a financial year, a balance sheet of 20 million euros, or net turnover of 40 million euros. In the other case, if you're a non-EU company that has a turnover greater than 150 million euro in the EU, you will also be subject to this rule. So what's required as it's written today? Again, this rule is still in development. The protocols are still in development, and it's expected to be released in June of 2023. But again, the rule is approved. So the directive requires that affected companies prepare and submit their first report, which the first of which is due in early 2025 and based on fiscal year 2024 data. And then secondly, you're required to track and disclose the required ESG information. And our list here focuses on the environmental only, but there's a lot more to it. But everything from the materiality process, the sustainability and ESG performance targets, goals, and metrics that you're setting, sustainability risks affecting the company, as well as environmental and social impacts. And I think that's where a lot of people get into the double materiality questions. Risks to operating results and business performance, environmental protection policies and actions, and other non-environmental requirements. There's also an interesting one requiring digital data and tagging, where financial and management statements will need to have reported sustainability information digitally tagged to a digital categorization system specified by the CSRD. And again, there's third-party assurances built in here, And while the limited assurance required is less strict than a financial audit, it still requires working with an independent sustainability reporting partner, organization, or auditor. So what's the timing of the final rule? As we've gone through it, from the initial proposals being issued in April of 2021 all the way through when the European Commission adopted the CSRD to replace the NFRD, revisions to the proposals, provisional agreements, and adoption have all taken place in under 2 years. This leaves less than a year until CSRD goes into effect, with the first reports, as we said, due in 2025 for reports based on fiscal year 2024 results. And again, the protocol is still being finalized, but the rule is approved.
Oh, sorry. Apologies, jumped ahead of myself. Thanks for covering the CSRD, Dominic. And just to recap these 3 regulations that we've covered today, we have the proposed SEC climate disclosure rule, which, still proposed, but possibly hitting the US as early as April of this year, which would affect public companies and would require scope 1 and 2 emissions, sometimes scope 3 emissions, as well as other requirements such as, risk disclosures. We have the proposed federal supplier climate disclosure rule, which is affecting federal suppliers with contract revenue of greater than $7.5 million. It also requires scope 1 and 2 emissions disclosures, as well as sometimes scope 3. And depending on the size of your contract revenue, SBTI targets. The CSRD, this one's the EU reg that, to Dominic's point, is already officially a rule and will impact some US-based companies. The disclosure protocol is still in development, but a number of ESG-related disclosures, including your carbon accounting, as well as requirements for third-party verification. So important to be following along with all of these, and also just the continued reminder that these are a select 3 rules that are emerging from thousands of rules that are showing up globally. So you may be subject to these in some final state if they are if they take effect as rule, but there are also other climate related rules that might be impacting you and your organization. So with that, Dominic, can you talk about when you should start working on compliance for these proposed rules?
Yeah, really, you should start today. What's being stated is really clear that climate risk is financial risk. And the sooner that you as a company can be proactive and mitigate these risks and can take advantage of the opportunities, the more able to be competitive your company can be. Again, regulations are coming. It's less a question of if, but when, and there's additional value to doing this voluntarily. So if we look at being proactive versus reactive, and we think about this as a continuum from being basic and reactionary on one end up to being proactive and being a thought leader on the other end. On one end, you're just towing the line closely and reactively trying to respond as challenges come. And this puts you in a position with higher risk potential and higher frequency for non-compliance and non-conformance. On the other end, by being proactive, you've set a strategic course to know you're steadily working towards compliance well ahead of actual enforcements and thoughtfully mitigating your risks. You're on the leading edge of things and able to innovatively think about not just the risks for your business, but opportunities that lie ahead as well. And so with that, I'd really like to talk about some of the risks of inaction and not being proactive. Inaction, particularly in the case that more than one of these rules is applicable to your company, can be risky, painful, and potentially very costly. There's a loss of investment, both institutional and individual, and potentially a higher cost of capital associated with that. There's potentially federal contract loss in revenue from that. In the case of federal supplier rule, you may be jeopardizing the contract if you're non-compliant. There's potential loss of license to operate, potential falling behind your competitors if particularly comparatively your CDP scores, for instance, are higher for your federal supplier competitors potentially. And then the business interruption that may be caused to address compliance in a short timeline. If you're reactive, what do you have to put on hold in order to scramble to get compliant in a short time frame? And then potentially the stress on your budgets and resources. What resources and budgets do you have to second if you did not strategically plan for what it takes to be compliant? What data will you need that you don't currently have on hand? I mean, a lot of this is managing risk, and you can't manage what you haven't measured.
Awesome. Thank you, Dominic. So now that you know more about these proposed and existing rules, as well as why you should start preparing today, I actually want to dig into how you can start preparing today. So one of the most important steps to figuring out your pathway towards compliance with an emerging or new regulation is to really understand where your business is at today in comparison to the requirements of the rule. So I always advise clients to do a gap assessment to figure out what the rule requires and what they're doing already that might, help them towards their path towards compliance, or where the gaps are. What do they need to do to be able to close those so that they can ultimately confirm compliance when the rule becomes effective or there is a compliance state in place. So I actually want to walk you through an example gap assessment for a major federal supplier today, and as you can see on the left-hand side, we have the rule requirement. So before you can even do a full gap assessment, it's really important to actually break down the rule into the actionable tasks that your company would potentially be required to complete. And breaking those actions down in layman's terms and into the tangible action that you would have to do can be really beneficial. We at Carbon Better have actually done the legwork on this for these proposed rules. So if you need help with your gap assessment, definitely don't hesitate to reach out to us. But in this example for the major federal supplier, which if you recall, they would be required to do scope 1, 2, and 3 emissions quantification, as well as disclosure of those emissions and their climate related financial risks to the CDP. And then there's also an SBTI target setting requirement. So once you know the actions that the rule would require you to do, there's where you then scrutinize what your operations look like today in comparison to those requirements. And from there you can assess, like, are you already doing this and like you just can continue on business as usual to meet these requirements? Are you part of the way there and you've taken some actions but you need to build upon those to be fully compliant when the rule hits? Or are you not even started yet or just not there? So in the case of this example, which is some nebulous company that doesn't exist, um, for quantifying their emissions for scope 1, 2, and 3, they're partially there. They've quantified scope 1 and 2. So to bridge the gap of the rule, they will have to quantify their scope 3 emissions. So they'll need to start planning for resources to gather all of that data, build out those calculations, and be able to do their scope 3 emissions ahead of their disclosure requirement. In terms of disclosing emissions and climate related risks to the CDP, they haven't yet done that. So they're going to need to figure out a pathway to answering the CDP questionnaires and getting those submitted. And then lastly, with respect to setting SBTI targets, this example is partially there. They have set targets to decarbonize for their scope 1 and 2 emissions, but they have not submitted those for acceptance by SBTI. So now that you've seen an example of what a gap assessment might look like, how do you actually close the gaps? So this requires planning and lead time to be able to get from where you are today to where the rule or rules might require in the case of multiple regulatory obligations. So one of the first things that's important to look at is your resourcing. Do you have the staff that you need and or the third party support in place to be able to confirm compliance with these proposed rules? This might require hiring. This might require, contracting with a third party. As noted by Dominic for the CSRD rule in the EU, that rule actually does require third party verification. But even in the absence of third party verification requirements in some of the other proposed rules, a third party support resource can be really valuable in helping you to validate your data, give that quality assurance and confirmation that your disclosures are accurate, and help you to mitigate risk as you work towards disclosing your climate impacts, possibly for the first time. Then you need to look at budget. So, have you actually allocated any budget to sustainability? You know, do you have the money to spend on these resources that you might need to confirm compliance? If the answer is no, I would encourage you to start planning ahead of your next budget cycle so that you can get line items for compliance with climate disclosure rules into your budget in a timely fashion. The next thing, and this one is actually, maybe one of the most trickiest ones to assess is do you have access to all of the necessary data? So depending on where you're at today with your carbon accounting and depending on what the rule requires, um, have you lined up the data that you'll need to do your greenhouse gas emissions calculations? And if, say, you need to calculate your scope 3 emissions, but you haven't done that before, um, how are you going to like reach out to your suppliers, reach out to everyone in your value chain, align your internal stakeholders as well to actually compile all of the data that you need, as well as starting to build out your calculation workbooks or software solutions, however you're going to quantify those emissions. um, it all requires a lot of data and business processes to make sure that you can get that data and you're not caught without what you need to be able to quantify your emissions. And then lastly, I think this one kind of touches on all of these other points from a planning perspective, is that it all takes time. And, if you need new resources, you might have to train those resources. Or if you're leveraging existing resources, there's training that might be required. There's, data needs that are going to take time to actually compile. And then there's also the budgetary planning, which can have a lead time. So it's really important once a rule becomes effective or even in its preliminary state to understand what your timeline to compliance would be and start working backwards from that so that you can ensure that you're proactively working towards compliance versus being caught in a reactionary state if and when these rules hit. Um, so with that, before I turn it over to questions, I'd actually like to do a quick plug for our second annual Earth Day event. So Carbon Better hosts a free day of climate action for businesses, where we will actually, with information based on electricity and natural gas, as well as square footage, we will quantify scope 1 and 2 emissions for a single day, reflective of Earth Day, and then offset those emissions for participating businesses. And we really want to show that, like, through a single day of action, you can, create a momentum, as well as, like, we want to make people realize that this is accessible, it is approachable, like, you can take action, you just have to get started. And if you can do it for a single day, then you can do it for longer than a day. So you can sign up via the QR code here. It's also on our LinkedIn and on our website. But we would love to get as many participants as possible. And we are also welcoming sponsors. So if you are interested in helping us offset participating businesses' emissions, don't hesitate to reach out to us and we would love to share more. So with that, I am going to open the floor to questions. Um, I also would like to highlight that you can connect with myself and Dominic using the QR codes here. And then if you're looking to stay abreast of all of the happenings with these emerging regulations, as well as other upcoming events, you can subscribe to our newsletter with that QR code. So with that, I see we already have several questions in our question box. So I'm going to pull those up. Um, so we have a question here around scope 3 emissions, which, as we've discussed today, has seen some pushback in the comments on these rules. So this question says, many measurements, particularly for scope 3 emissions, are based on imperfect measurement or imperfect estimates. Are there guidelines for the accuracy of the measurements? So to your point, a lot of carbon accounting is based on on estimates, right? We're not able to directly measure from every point source and every mobile source of carbon emissions. So with respect to guidelines, the GHG protocol that we referenced that is specifically referred to by the proposed SEC rule, that GHG protocol actually does give guidelines on different types of emission sources across scopes and the best ways to estimate those as well as emission factors. And then there's also a number of other, guidance and reference sources that you can utilize for estimating your emissions in the most accurate way possible. So, the Environmental Protection Agency also has emission factors. Those are typically heavily referenced for scope 2 location-based emissions. But the goal is to be as accurate as possible while also quantifying your emissions in a really traceable way. So when you do your disclosures, you can also disclose how you did your emissions calculations, the emission factors that you used, the calculation methodologies that you used, and that can help not only ensure the accuracy, but can help people understand, which methodology you chose in cases where there are multiple choices in terms of how to quantify the emissions. Let's see. The next question that I'm going to jump to is, does the CRD also cover non-US, non-EU subsidiaries, i.e. Asia Pacific of EU companies? Dominic, can I toss that one to you?
Yeah, I think we can answer that. If we look at the two factors to determine applicability, the second one was that non-EU companies that have a turnover greater than 150 million euro in the EU. So I think the answer to that is yes. If you are a non-US, non-EU subsidiary, i.e. Asia Pacific, and you do business in the EU and your turnover is greater than 150 million euro, then this would be applicable to you.
Awesome, thank you. And I actually just pulled that slide back up that
Yeah.
has the breakdown there for your reference. All right. The next one, is there a specific framework that SEC will require through which companies will need to disclose? Like for major requirements, they require disclosure to CDP. Dominic, since you covered the SEC one, I'm
Oh,
happy to take
sorry.
that one to you.
I
No
was
worries.
out for a second. Um, there's not a specific framework, but I think that everything is alignment with a number of the generally accepted frameworks that were referenced. So the TCFD and the greenhouse gas protocols, those are leaned on very heavily in the disclosure requirements. And so is there a specific framework that is unique that's being created? I think the answer is no. Is it leaning very heavily on the frameworks that are generally accepted to be in the space to be very grounded and very solid? The answer is yes. And I think they're trying to, in the disclosures, make it as easy as possible for people in the current frameworks that are existing in the space as generally accepted to be very good.
Thank you. And just a reminder too, with any of these answers are of course in the context of how the rule is currently written,
Yeah.
and with these being proposed states, like that could very much evolve. So I just wanted to make that clarifying point as well. That is all the questions that I see in the question box. Let me check the chat as well. It looks like there are no questions in the chat, so we can give folks maybe a couple more minutes to type any last minute burning questions. But you are also welcome to reach out to us after the session has ended if any questions arise. All right. Well, with that, I want to thank everyone for taking the time to attend today. As Chris mentioned in the chat, the session was being recorded, and that recording will be circulated as well as posted to our website for any replay needs. And we look forward to being a support resource for anyone that needs help on their sustainability journey or with complying with these proposed regulations. So, with that, thank you, and we look forward to catching you at the next event. Okay, bye.